Now.
All right, I'd like to thank everybody for coming out and David for the invite. It's a pleasure to be here. Today, we're going to talk about commodity options. If you've ever been to any of my webinars in the past, you know it's generally very structured slideshows. We're going to start that way, but then we're going to venture off into some charts and looking at some option chains and things like that. There's some interesting things going on in commodities, and by interesting, I don't necessarily mean good, but we'll talk about that. Just for informational purposes, this is my name, my contact information. If you have any questions or if you're interested in learning more, that's how to get a hold of me. You can also find me on social media, Facebook, Twitter, Instagram, YouTube. Just search for Carley Trading and we'll come up. I am from Las Vegas, believe it or not. People do live in Las Vegas. In fact, it's growing extremely quickly, too quickly, in my opinion. But here we are. It's nice and sunny in Vegas, unlike Chicago, which is cold and dreary most of the time. But even though that's where most of the commodity brokers live, I choose to live here. I just mentioned I'm a commodity broker. We run a boutique shop here in Las Vegas. I also have written multiple books. I can contribute content to Jim Cramer's Mad Money as well as Bloomberg Television, which we just did today, talking about natural gas. I also write a monthly column for Stocks and Commodities magazine. And I write a couple of newsletters for our brokerage clients. Again, we are a brokerage service. That's how we make a living. If you're interested in learning about some of the things that we talk about today, these are the 3 latest books that I've written. If you go to Amazon and you see other books, just honestly completely ignore them. They're older versions, older publishers. These are the newest, best, and most updated. So look for those. And, want to make sure everybody's on the same page as far as risk goes. Trading is not necessarily investing, or at least not what we're talking about today. It is speculative, and sometimes it goes really well, and sometimes it does not. There's definitely substantial risk involved. A lot of people are hesitant to trade options. Options are not as simple as futures or stocks or whatever it is you're trading. The math is fuzzy, and it turns a lot of people off. But the reality is there's some very, very compelling reasons to trade options for some people. Now, before I start as to explaining why I think options are at least worth a look, I'm going to first say trading is a personality thing. The goal is find what fits your personality. If you're trading in a manner that causes you stress or anxiety, it's not a good look, and it's probably not going to work out for you. You want to do what you're most comfortable with, go with the flow, and you'll hopefully make better decisions. So options offer traders flexibility. You can literally create any type of strategy, risk, reward, and we're going to go over several examples today on how you can put together a trade using combinations of long and short calls and puts that fits your style, your comfort level, your risk level, so on and so forth. Generally, not always, it depends on how you're approaching it, and it depends on the market conditions, but generally there's going to be less volatility when it comes to options versus futures. The position and account profits and losses are going to move at a slower pace. This is really good if the trade is losing, and really bad if it's winning, because it can get frustrating if you're extremely right and your options get in the way. That does happen. So there's no perfect way to approach the markets. If you're trading futures, you either have to choose between placing a stop, which has a good chance of being you're being stopped out before the market goes your way, or not working with a stop and occasionally getting caught in some huge move that you didn't expect. So again, there's no perfect way to do this. Options is just one way. There's some advantages, but there's also some disadvantages. The great thing about options is you give yourself some room for error. You can trade spreads, you can collect premium, you can do all sorts of different things that eliminates the necessity of perfect timing or price speculation. There are some strategies that you could be wrong and still make money. You can be early or late and still make money. Again, it's a trade-off for other opportunity costs, but this is just one way to go about it. Options generally come with lower margin and lower risk, but again, it depends on market conditions and how exactly you're employing your strategy. Again, generally speaking, it's a smaller cash outlay. You can spend less on your speculation, possibly risk less on your speculation, and maybe even trade in a smaller account than you would if you were trading outright futures. And you can, in some situations, you can let time value work in your favor. Now that can easily work against you, even if that's not your intention. For example, in natural gas, anybody that had any short option premium out there at all in the last couple of weeks is just getting plowed over. And that includes people that were trading option spreads that were intended to be bullish, which is what happened to us and a lot of our clients. We were bullish nat gas, we were long futures, long calls, and then we sold calls to hedge. And guess what? The out of the money calls actually picked up as much or more value than our bullish positions, which is something that generally doesn't happen in a textbook scenario. But when you get a market that's dysfunctional, those kinds of things happen, and it's rare, and frustrating, but it does happen. So again, there's always advantages and disadvantages to this type of trading. There is no holy grail. So I already mentioned that trading is 99% mental, or at least I mentioned it's a mental game. My estimation is it's about 99% mental, and I truly believe that. As somebody that grew up playing sports, I also believe that that's the same thing. There were a lot of people that were in much better physical shape than others that didn't perform under pressure. And guess what? The better ball players were the ones that were mentally capable of handling the stress, and it's the same in trading. It's my opinion, and again, everybody has a different personality and a different way of looking at things, but it's my opinion that trading options as opposed to trading futures, for some people, particularly for me, it takes some of the stress out of it. It's not quite as stressful to see an option spread perform as it is seeing a futures contract tick up or down, or maybe rip up or down. You should be looking at options as building blocks. When I talk about option trading, I'm not really talking about buying calls or buying puts and seeing what happens. That type of strategy can work occasionally. In fact, it worked really, really well in 2021. A lot of people made a ton of money buying calls in stocks, right? Or calls in the stock market. But that was an exception, not the rule. And my guess is people that were employing that strategy very well in late 2020, early 2021, probably have given most of their money back, or maybe even all of it. And the reason is options are eroding assets. So ideally, rather than just buying calls and buying puts, in some situations, or in most situations, you're probably better off working some sort of spread. If you're going to buy a call, maybe sell a put and sell a call to pay for it. Maybe sell 2 calls to pay for it. There's all types of different strategies you can do. The idea of using options as building blocks and building spreads is the legs of the spread work as hedges. They're antagonistic to each other. And you can mitigate your time value exposure. If you've ever bought an option and watched the premium just slowly decay to nothing, you're not alone. That happens more often than not. So if you're selling premium around that option that you're buying, you're reducing the effect of that erosion. In fact, you're benefiting a little from it. And the great thing is there's really no limits to the possibilities. If you're creative, you can put together any strategy that you could dream up, any risk reward. You could even put together a strategy that has 0 risk and 0 reward. I'm not saying you should do that, obviously. There's no benefit to you. There's only benefit to your broker, but it is possible. You can literally do anything you want. The one thing that I tell people is most important about option trading is the delta. Always be aware of the option delta. Whether you're trading a spread or a single option, know what the delta is. The delta is the rate of change in an option or option spread versus the change in underlying futures contract. You should know that delta can change itself. Sometimes the delta, for example, when you enter an option position that has a delta of 30, if the delta is 30, that means for every point that the underlying futures market moves, that option moves 30%. Today, your delta might be 30. Tomorrow, that delta might be 50, or it might be 80, or it might be 5. It's not something that's set in stone, and too many people get it in their mind that when I entered the trade, this was my delta and that's what it's always going to be. And that's absolutely not the case. In fact, that type of thinking is going to get you in trouble. But the reason delta is important is because it allows you to manage your risk. And when you put your strategy together, it allows you to decide how aggressive or conservative you want to be. To give you an idea of what I'm talking about here, a futures contract has a delta of 1. An at-the-money option has a delta of 50. So if you go long one futures contract and sell a call option against it, you've lowered your delta to 50. You've also created a scenario where you collected premium to go long that futures contract. The premium that you collect is cushioning your downside risk. But if the market is at the same price it is when you enter the trade at expiration, you get to keep all the premium you make. I'm sorry, the premium you collected. So why this might make sense is some people look at this and say, well, why would you limit your profit potential to the premium you collect on the option? And I get that, and that's a valid concern, but the reality is if you can, let's say, for example, in a market like gold, you can generally sell an at-the-money option in gold, depending on volatility, for anywhere from $4,000 to $6,000. So let's say you sell it for $5,000 and it expires in 50 days. You get to keep that $5,000 if gold is at the current price or higher. So not only do you not have to be right in the direction, you just have to be not wrong by $50. So if gold is $50 lower, you basically break even at expiration. And if you want to get more bullish, you can buy or sell many futures contracts against your position to get the delta to where you want to be. So for instance, let's say you have a cover call at the money, your net delta is long 50. If you want to be a little more long, you can maybe buy a micro gold and put your delta to 0.60. There's all types of things you can do. Knowing your delta is imperative to being able to hedge. If you know what your delta is, you can constantly hedge when things go wrong. Well, I shouldn't say constantly, but you can effectively hedge when something goes wrong. If something's going wrong, don't stick your head in the sand. That's easy to do, and that's human nature. But the reality is that not only does that not work most of the time, it is a very good way to turn a small or reasonable loss into a really big loss. It's always better to play defense first and then worry about playing offense when things go wrong. Now, with that said, I mentioned natural gas a few minutes ago. And to be honest, in natural gas, in a situation like that, I mean, we're talking about something that happens once a decade, so it's not something common. In fact, the implied volatility in natural gas options yesterday was an all-time high. So not only is it a once in a decade event, but once in forever event so far. And in that situation, we helped we had some clients with some positions on, and some that we had recommended as well, and we were helping clients hedge. But the reality is, with that type of volatility, the options don't behave in the way they normally would. Hedging is very difficult because even if you're using a mini contract, which is a quarter of a contract, if natural gas is moving 10% up or down every day, you have a good chance of getting chopped out. So there's all kinds of things that can go wrong. So again, I'm just trying to let you know that sticking your head in the sand is not the right thing to do. But at the same time, there is no perfect scenario. Just because you're diligently hedging doesn't mean that everything's going to go exactly how you planned. So that's trading, I guess. You never know what to expect. I've come to the conclusion that the best way to approach options is using option spreads and being extremely cheap. Strive to be cheap. In other words, use the market's money to purchase options, or the market's money to hedge your futures by selling premium around your futures, not your own. That said, nothing in life is free, especially not a free option trade. So if you are selling premium to pay for your long options, or if you're selling premium to hedge your futures bets, You're giving something up. You might be giving up profit potential. You might be accepting risk. And we'll look at some examples so you have a better idea of what I'm talking about. In a nutshell, most options do expire worthless. Behave accordingly. Also, most options lose value consistently, so behave accordingly. It's generally better to be a net option seller. I'm not a big fan of spending a lot of money on option premium because it's typically a losing strategy in the long run. You would not believe the prices that we're seeing for natural gas options. There are people that are willingly paying several $1,000s for natural gas calls with a strike price of $15, $16, prices we've never seen in the history of natural gas. These people are paying thousands of dollars to own those call options, which to me is just completely irrational, but it is what it is. I remember the same thing happening in crude oil in March of 2020. Well, it was actually more like May when crude went negative. There were strike prices in the -10, -20, -30 range that people were spending a lot of money to purchase. So sometimes traders are irrational. Whoops. All right, so I'm going to switch my screen here and I'm going to show you a few things that we've been looking at over the last couple of days. Actually, first thing I'm going to do is show you an option chain in natural gas. Okay, you should be able to see a natural gas chart. This is a weekly chart. If that's not what you're seeing, please let me know. But I think that should do it. So this is what a weekly chart of natural gas looks like. We can see that natural gas has had quite the run here in the last couple of weeks. Basically what happened is we broke over this trend line around 330-ish and never looked back. Honestly, it's just been a straight shot. It ran into a little trouble here around 425, 430, but that was short-lived and off to the races we've been. However, you'll notice that we've run up against a weekly trend line. And my personal opinion is last night in the overnight session, we got up to about 640, 650. Believe it or not, we actually were targeting these areas. We were a few dollars ago when natural gas was down here in the 4s and 5s. We legitimately thought this is what was going to happen. This is where natural gas is going. And we prepared for that. We had option spreads and things going on. When I say we, I'm talking about the clients that I work with. We legitimately believed this was going to happen and we were prepared for that. However, the option market became so dysfunctional that even trades that on paper were perfectly wonderful, in reality, they just were not working. To give you some ideas, as the market was skyrocketing higher, the call options were exploding in value. Of course, that's to be expected, but the put options were not losing value at all. In fact, they gained value. So just imagine if you were long futures and you sold some puts as well, so you had a bullish trade on, and then you also sold calls against those at some point. The call options were gaining value so quickly that they were actually keeping up with or outpacing the futures, which really shouldn't happen. If you go long a futures contract and you sell an at the money call, the delta should be roughly 50%, meaning you're net long. But what was happening was, as the futures were going up 10 points, the options were going up 9.5. So there was really no gain on any of that position. And then the short puts were not only not losing value, but they were gaining value. So all these bullish trades were actually losing money, which is pretty absurd, but sometimes that happens when humans get evolved and they're panicking and they're buying and selling instruments because they have to, not because they want to, or because they think they have to. So hopefully if the market calms down a little bit, everything will come back into line and normalize, but only time will tell. So with that said, just because somebody was right on this move doesn't mean they made money. That's all I'm trying to say. This is a really treacherous market. And also the liquidity dried up in the options, which made it even harder for anybody trying to trade this. And you might be saying, well, if you were just long futures, it would have been simple and you would have made a killing. And If you look at this weekly chart, you might think that, but if you look at a daily chart, you can see it's not that easy. These are really big moves per contract. So just this little pullback here was $8,000 per one lot, or $9,000 or $10,000 per one lot. These little switchbacks that we're seeing here back and forth are $9,000 or $10,000 per contract. So, you know, maybe if you went long and didn't place any stops and just turned your computer off, maybe you did very well. But in reality, my guess is most people are just getting completely obliviated, even if they were right. So it's been a tough market. And let me just show you what these options look like here, just to give you an idea. Natural gas, I'm going to pull up a monthly chart here. So here's the other scary thing I should point out also, which is complicating the volatility, is natural gas in 2014 topped out right around here, about 650-ish. And then as you can see, it came down pretty sharply. I don't think we'll get a repeat of that. I do think we've probably seen the highs. I think we kind of stabilize around here. And the reason I think that is the craziness going on in Europe, holding natural gas prices up. Also, it's just so early in the season. We don't know what the weather is going to be like. Is it going to be a cold winter? Is it going to be a warm winter? So I don't think traders are going to be willing to bring prices all the way back down just yet. But the interesting thing is, if we do break above 650 and hold, the next target is $9, and nobody wants to be caught in a trade that goes to $9. So that is just this chart alone, the fact that the resistance areas are so far away from each other is complicating the situation. But ironically, the option market is basically already priced in a move to this price, to about $9. And how I know that is, if we look at the December $8 call, today, actually, I thought they'd have the option settled, but they don't. So yesterday, that option settled at 80 cents, which means if you bought that option for 80 cents, that's about $8,000. That means that for you to break even, nat gas would have to be at 890, 880 at expiration in 45 days. So the market is already priced in that move. So the good news is, if you do happen to have some option spreads on with some short calls, we've already kind of priced in almost the worst case scenario. So hopefully it should get better from here, but you know, who knows? Crazier things have happened. We just got done telling you to be cheap, don't spend a lot of money. But look at this. If you wanted to pay, I mean, if you wanted to buy an $11 call, natural gas hasn't been to $11 since 2008. Now, some people might say this is different, but I just have one word for you, and that's fracking. I agree 100% that there's a different political environment here. The US shale producers are under a lot of pressure to go green. There's all kinds of things going on. So yes, it is different, but the reality is, just a year or two ago, we were energy independent. In theory, we could do that again. I think if shale producers keep seeing these prices up in the $5, $6 range, they're going to bring supply to the market. So I'd be really, really hard pressed to see something like this, something like the $13 or maybe even $15 that we saw in 2005, 2006. So in any case, there are traders that think that natural gas is going to not only 7-year highs, which is where we are, but maybe 10-year highs. So maybe even longer. So they're purchasing these $11 calls. Yesterday, they would have had to pay 40 cents or $4,000 for that call. So again, it's pricing in a move way up there that has not occurred yet. So if you're trying to buy, all I'm trying to say is, if you're trying to buy call options now, good luck. You probably missed the boat, because not only does the market have to rally to almost double its current price for you to break even at expiration, for you to make money on that option, it's going to have to do a lot more than that. So could happen, anything could happen, but it's not likely. A trade that we put out, let me switch my screen here, sorry. A trade that we put out to our clients that is causing quite a bit of strife, and on paper it shouldn't. It actually was a fundamentally sound trade. I don't remember the exact date. I want to say maybe a week and a half, 2 weeks ago. We put out this recommendation to our clients. Hopefully you can see it. If you can't, please let me know. But you should be seeing a newsletter. Yeah, okay. Should be seeing a newsletter. It's the Carley perspective. We do write this and send it out to our clients, depending on where we see opportunities. Sometimes it's once or twice a week. Sometimes we don't write any. It just depends on what's going on. In this particular case, I wish I wouldn't have written it, but looking back, honestly, if I saw this set up again over and over, I probably would have done the same thing because it makes a lot of sense. Here's what the trade was doing. It's a call ladder. And I just told you, when volatility is high, you don't want to spend a lot of money on option premium. You want to use the market's money to pay for your trade, okay? So this particular idea was to purchase a $6 call. Let me zoom this in just a little more. Okay, so we were purchasing a $6 call, and that at the time the market was at 540. So we were looking, again, I told you we were expecting natural gas to go higher, but ironically this trade really bit us in the hiney. So we went long the $6 call, but instead of paying for that $6 call outright, we decided to sell some premium. Just trying to see. So that call option at the time, I'm looking at the prices down here on the trade window. That call option at the time was about $5,000. So instead of paying $5,000 for that option, we decided to sell a $7 call and an $8 call. Oops, I moved the screen on you. So after doing that, and keep in mind, we did this after volatility was already high. Now, it wasn't as high as it was now, which is basically an all-time high, but it was really high. It was the highest it had been in several years. So in our thinking was, even, if natural gas continues higher, we should be fine. The volatility is already priced into the options, and we're looking for natural gas to get to $6 to $6.50. So selling a $7 call and an $8 call seemed like a perfect strategy because we were getting the $6 call for free, basically. We were actually collected a couple $100 for that. So the market was paying us to take this trade. What we were giving up in as an opportunity cost was risk above the extra short call. The extra short call with an $8 strike is essentially naked. Now there's something to keep in mind here. In a normal market, that $8 call wouldn't really get into trouble unless natural gas went significantly above $8. And the reason I say that is we're long a $6 call, we're short a $7. So between $6 and $7, we make that dollar in premium, which is $10,000. So we make $10,000 between 6 and 7. And then our intrinsic risk doesn't kick in until $8. At $8, we're naked. Above $8, we start giving our intrinsic profits back, and we run out of money at 9. So if we held to expiration, the only way we could lose money on this trade is if natural gas is above $9. I mean, it's really hard to argue with that type of a strategy. On paper, it looked great. But what's happening is, even though we were right about the direction, the market went above 6. In fact, it went to 650, just like we thought it might. What we didn't account for was, number one, the move happening as quickly as it did, and the volatility spiking. Just to give you an idea, when I say high volatility, just let me put this in perspective. The natural gas volatility reached 140 yesterday. So if you follow the VIX and the S&P, it's basically the same thing. It would be like the VIX being 140. As you can imagine, if the VIX was 140, the S&P would really be in a whole heap of trouble. It would be really, really ugly. I don't think even in March 2020, it didn't get to 140, if I recall. I think it got to maybe 100. Could be wrong. I'd have to look that up. But anyway, 140 is just off the charts insanity. We did not anticipate that, and it caused quite a bit of trouble here for this trade. Now, for those traders that had the margin to ride this out, they're probably going to be just fine because the odds of natural gas being above 9 are not very great. But the sad part is it was a lot of risk and it doesn't look like we may or may not be able to unwind it with any sort of profit, just simply because of the dysfunction in the option market. So it's kind of a bummer. But again, this is a once in a decade or once in 20-year kind of situation. It's not like this happens every day. In a normal scenario, this is a really, really great way to get into a market without spending a lot of money. And the great thing is you have no downside risk. So one of the compelling reasons to do this particular strategy is natural gas was already at 540. It hadn't been at 540 since 2014. So we were already in multi-year highs. The market was pretty wildly overbought, or at least we thought it was at that point. Little did we know it was only just beginning. And so the last thing you want to do is chase a market higher. And it's true, you could simply go long a future and place a stop, but we all know how that works. You can see there's a few down days on in the rally. If you had a tight stop, you were going to get stopped out before it worked out. If you had a deep stop, you could risk quite a bit of money just waiting for something to happen. So a call ladder provides you the ability to get in with no downside risk, but you're accepting upside risk in exchange for that. In a normal market, that wouldn't have been such a big deal. Natural gas is not currently a normal market. So it's been frustrating, but this is a really good example and a reminder of when you're trading commodities, always make sure you have excess margin, because it's these types of trades that go wrong on a rare occasion that can really ruin a trading account if you're over leveraged. If you have plenty of margin and you're not over leveraged, you might be bummed out for a couple of weeks, but the reality is it'll probably come back to normal. This type of volatility can't last. In fact, my thought is we've probably, and this sounds mean, but this is just how markets work, we've probably wiped out all the shorts. There was a big speculative short position coming into nat gas a few weeks ago. Probably squeezed out all the shorts. We've probably squeezed out all the retail speculators trying to buy options, because we've seen natural gas move up and down 10%, whipsaw the last couple of days, and I suspect not many people have survived. So now that that's out of the way, we probably just kind of flatline. My guess is nat gas pauses. We might trade somewhere between 650 and 550, which is a pretty big range, especially for gas. I mean, if you look back over the last couple of years, there were years that we didn't move $1 in an entire year, and now here we are doing it every other day. So it's an interesting situation. I'm going to look at, let's take a look at gold and silver ideas. We put these out a few weeks ago. So far, so good on these, nothing crazy, but this is just to give you an idea of a different way to allow the market to pay for your premium. So in this situation, this is December silver, and the idea is the trader wants to buy a call option. It's a 22.50 call for December, which at the time of this was about 80 cents. So if you trade silver, you know that 80 cents is quite a bit of money. It's roughly $4,000. So instead of paying $4,000 for an option that might work out, but probably won't, because that's just how, options are priced to lose. Instead of spending $4 grand of our own money, we could sell premium around it and use the market's money. So we could buy the 22.50 call, sell a 23.50 call, and then sell a 20 put. The two options that we collect money on helps to cover the cost of our long option. The long option's the money maker. The other two are hedges. As the market goes up, you're making money on the long call, making money on the short put, and losing money on the short call. So you're making money on 2 out of 3 if the market goes up as you expect. If the market goes down, you're losing on the short put, you're losing on the long call, but you're making on the 23.50 call. So there's a little bit of an inherent hedge. If the market trades sideways, instead of losing the $4,000 that you used to purchase that call option, if the market trades sideways, the other two options erode in value to a point where you basically just wash out, or you end up, let me see, in this situation, we were paying about $400 to get into the trade. So instead of paying $4,000, it was 400-ish. And if the market trades sideways and silver is above 20 or below 23.5 at expiration, you lose your $400. So not the end of the world, not ideal, but not the end of the world. So that all sounds great. However, you have to keep in mind, if you're selling an option to pay for your long options, you're accepting risk somewhere. In this case, we're long the 2250 call. So when we sell the 2350 call, we have no upside risk, because above 2350, those options basically cancel each other out. Your profit potential is capped, but your profit potential is capped at $5,000. So that would be a pretty nice trade. If silver collapses under $20, that's where things get hairy. Under $20 is like being long a futures contract naked. You have unlimited risk below 20. So this type of trading isn't for everybody, because first of all, it takes a good amount of margin, especially in the silver market. But also you have to have the mental ability to accept that risk, and not everybody is. Some people can accept the risk of trading futures, even though theoretically in futures you have unlimited risk, because they place stop orders. Some might even be shocked to know that stop orders are not guaranteed. The Chicago Mercantile Exchange has a mechanism that prevents stop orders from getting too much slippage. And so it's very possible, if a market gaps from, let's say, Friday night's close to Sunday's reopen, or it moves really wildly during the day, it's possible. It's not something that happens all the time, but occasionally it does happen. The market can literally run right through your stop and not fill you. So stops are not a guarantee. However, for some reason, people are more comfortable with that as opposed to selling premium. I get it. And again, it's a mental thing. So if mentally it really stresses you out and you can't sleep, if you sold a naked put to pay for your silver vertical spread, don't do it. It's not worth it. You could do the same thing in gold. Again, this is a few days ago, and these are making a few bucks, but I'm just trying to give you some ideas on how you can approach the markets creatively without spending a lot of money. And again, these are ideas that we gave to our clients, our brokerage clients. Just trying to see. So in this gold spread, you could have bought the spread for about $250. So it's a 100-point spread. You make money between $1,750 and $1,850. That's $10,000 in gold. You're only paying $250-ish to get in, because you're selling the 1675 put to pay for that option, to pay for that vertical call spread. Now, when you're doing this sort of thing, never underestimate the risk of having a naked option out there. So don't just blindly sell an option because of the premium you can collect, and that's what you need to cover the cost of your trade. Don't do that. Make sure you're selling premium at a price that's below support, a price that hopefully will not be seen. Otherwise, you're going to really cause yourself more stress as opposed to less stress. So in this situation, we were selling the 1675 put to pay for our call spread. And again, it's $250 to get into this particular version of the trade at that time. And the trade makes roughly 10 grand. So you can see the risk. Well, I shouldn't say risk reward. The out-of-pocket expense versus the profit potential is quite large, but the risk is unlimited under 1675. So if something goes wildly wrong, you have to be careful with that. In a previous slide, I mentioned don't put your head in the sand, don't just ignore what's going on. And I truly mean that. So if you did a trade like this, there's a few things you can do. Options move quickly, and some people are stunned by the speed at which options can move. So if you sell that 1675 put today, let's say it's about 25 points or 2,500. I think that's roughly what it is. If something weird happens, you can see a few months ago, we saw this really big spike down. If something like that happens, that option that's $2,500 today could be worth double. It could be worth 5 grand. So suddenly you're losing $2,500 on the option that was simply meant to finance your trade, and that can be quite stressful. But there's things you can do to protect yourself from something getting wildly out of hand. If it does look like things are starting to go south and the option has picked up so much value quickly that, I mean, of course, you can always buy it back, but the thing about options is when they increase in price very quickly like that, they usually decrease in price just as quickly. So it's, if you're constantly locking in losses on the short options that you were collecting to finance your trades, you're going to probably have a really hard time coming out ahead. With that said, what I would say is consider hedging. Watch your delta. The 1675 put when you originally sold it probably has a delta of 20. So if you sold 1 or 2 micro futures against it, if things started to look like they were breaking down below support, you would literally basically lock in the delta on that. So meaning you would go neutral and then see what happens. And if gold continues to go down, maybe you sell another mini future or micro future and just try to keep your delta as neutral as possible. I know it's going to be a little bit hairy, but it's generally a reasonable way to go about it. That way you don't get caught with a huge loss and a really frustrating scenario you can't bounce back from. So if you're going to do this sort of trading, all I'm trying to say is be proactive and don't be afraid to hedge it. Sometimes the hedges end up costing you more money than you were trying to protect. That happens, but in the long run, you're better off playing defense first and then worrying about offense. This is a trade that we did in wheat a few weeks ago, and honestly, it's just about the same thing that we just showed you in the metals, so I'm not going to spend too much time on it, but just pointing out, you can do this with basically any market. Again, you want to be selling premium below support. You can see we still chose to recommend selling the 650 put, which was below support. It did spend a little time in July under that, but not much. And market was coming up against trend line support, and so it seemed like a good idea to go long wheat. This trade, if I remember right, let's see, it cost about 300 to 350 to get in. So this is a small out-of-pocket expense. As long as wheat stays above 650, which it had since the spring, it should be hopefully low stress. And so far, so good on that. But let me see if I have. Okay. So we just spent a whole lot of time explaining how you should use the market's money to pay for any options that you buy, so on and so forth. Most of the time, that's true. There are times where that's simply not true. If you look at, if anyone follows the currencies, they know that we are currently in a very, very low volatility period in currencies. And I'm not talking about the last couple of weeks, I'm talking about the last couple of years. If you pull up a monthly chart of the euro, what we're seeing now is so muted compared to what we saw 5, 6, 10 years ago. And as a result, the options are really, really cheap. So in my opinion, it's just not worth selling a lot of premium in the currency markets, because eventually that volatility is going to come back. And if you're selling premium in currencies right now, you're selling really from the discount rack. If volatility comes back, you're going to find a very small reward for a very large risk. And also, it doesn't really allow you to put together any good spreads, because you have to sell options so close to the money to get enough premium to make it worth your while, that it really just doesn't, the math doesn't work out. So if you're looking to trade currencies at this particular moment, honestly, I think the best route is to just buy a cheap option out of the money and let it rip, see what happens. A few days ago, we were recommending to buy December Euro 118 calls. This is what we call a flyer. It's a cheap option. Maybe it works out if the euro reverses, which I think the euro will reverse. I think we're in the process of putting in some sort of a bottom. And if that's the case, we should return to 119-ish. So if you buy a 118 call for December, it has a little over 60 days. And this isn't a recommendation. This was on a newsletter we sent to our clients, but I'm not telling you should go do this. The price has changed. I actually think it's a little cheaper now. but I'm just using this as an educational example. It doesn't always make sense to sell premium. In this situation, the 118 call option, it's not that far out of the money. We were just there a few weeks ago. And if we come back up to the top of the trading range, it should be nicely in the money. And this option is only going for about 30 ticks, or roughly $380 to $400 at the most. So that gives you 60 days in the market with theoretically unlimited profit potential. So if something really gets wild, who knows, maybe you could make a lot of money, but if not, you're out the $400 you paid to get in, or whatever it is. It's probably a little cheaper than that. And just on a side note, one of the reasons, in addition to the chart, you can see the chart shows that we're coming up against some support levels. We're oversold. That doesn't guarantee a reversal, but it's usually a pretty good indicator that we're due. But if you take a step back, this is a weekly chart that includes the commitment of traders data that the CFTC issues, and you can see that we're really just on the cusp of either the euro holding and running back up, or melting down and going into the low dollar area. So it could truly go either way. And we've been watching this for several months now, and it just doesn't seem to, the euro and the dollar just don't seem to want to pick a direction. So they're just kind of hanging in there. Eventually they will. And when they do, it's going to have a big impact on basically all the risk assets, stocks, commodities, everything. So it's going to be something to watch. If the dollar goes up, that's generally bearish for commodities, and it's a headwind for stocks and vice versa. So you want to just at least be aware of it. But speculators have basically liquidated all of their net long positions in the euro and have gone neutral. And they've basically liquidated all their net short positions in the dollar, and they've gone neutral to slightly bullish. So all those big speculative positions that were built up earlier in the year when everybody assumed the dollar was going down and the euro was going up have been unwound, which means there's a lot of ammo for traders to use if that trade returns. So we'll see, it'll be interesting. Okay, so let's just kind of summarize what we've talked about today. Trading is a mental game in which market participants are competing against themselves as well as others. So find what works for you. It doesn't matter if it works for someone else or somebody else made money doing it. Honestly, that means nothing. It has to be something you're comfortable with and you trust. If you trust it, you can employ it, and hopefully your edge will work out. And we talked about a lot of spreads, but I should have mentioned you can rearrange them. They're building blocks and you can build them any way you want, but you don't have to stick with what you've got. You can adjust them as you go. So for instance, with the bull call spreads with the naked legs that we looked at in gold and silver, what if you put that trade on and silver rallied very sharply? At that point, you could buy back your short put, because that's where most of your risk is anyway. Buy back the short put, take a profit. And if the premium on the calls, the silver calls, was really fat and you felt like the upside potential was probably limited, you might even consider, instead of basically selling an extra call and turning it into a ladder. So you just went from a bull call spread with a naked put to a call ladder. And you could do that back and forth as the market fluctuates. So you can always rearrange your trade. You don't have to put it on and leave it to expiration. In fact, I wouldn't ever really recommend holding to expiration. You're better off adjusting with the markets, especially if you're selling premium and you have naked options out there that are used to finance trades. Don't just ignore it and let it dwindle to nothing. If you've made most of the money on it, buy it back, because that's where all your risk is. If you, for example, I've seen people that sell options that, let's say we sold an option for $1,000 to finance one of our trades. If that option loses most of its value and suddenly it's worth $200, $300, you might as well just buy it back, because to squeeze out that extra couple $100, you have unlimited risk. And the longer that you have a position on that has risk like that, the higher the odds of being in the wrong place at the wrong time and really causing yourself a headache. So with adjusting, you can actually, in some situations, and again, this requires keeping a mental stability, and that's hard to do. But if you've put yourself in an environment where you can make good decisions and you're not stressing yourself out, you very well might easily be able to turn a losing trade into a winner just by adjusting and writing out the volatility. So just keep an open mind. Don't give up. Don't get frustrated. Understand what your analysis is, what you think your edge is, and go with it. The reality is you have to be in it to win it, and thinking outside the box can go a long way toward keeping a foot in the door with an acceptable amount of risk. If you're interested in learning more about some of the spreads that we talked about today, you can, well, I've written multiple books, but specifically today's topic can be found in my book. It's called Trading Commodity Options with Creativity. You can find more information at TradingCommodityOptions.com, as well as sample chapters, things like that, to see if it's worth your while. It's generally cheapest on Amazon. I think most books are, and there's a Kindle version. You don't have to have a Kindle to view it. You can view it on any electronic device, but the Kindle version's only, I think, $9.99, if I remember right. And this is what the cover looks like. Don't make the mistake of buying the other commodity options book, the black one. That one's been out of print for quite some time, and you will find it listed on the secondary market, but don't do that. It's really expensive and it's not worth it. This one's newer, better, updated. So I hope that you picked something up from today's class, whether it's just a different view of option trading, different view of adjusting trades, things like that. The ability to think outside the box when it comes to putting a strategy together. We do have quite a few educational videos on DeCarleyTrading.com. They're free, so feel free to go and check those out. And if you have any questions or comments or concerns, you can reach us at DeCarleyTrading.com. Again, we are a brokerage service. That's how we make our living. We provide support and guidance to clients, but of course, they make their own trading decisions. And I guess we have at least a minute or two. If there's any questions, I can answer questions. Okay, so somebody asked, why go short calls? Well, it's not always appropriate to go short calls, but if they're really expensive, it can be a good way to chip away at the market. If you're going to sell calls, always be proactive in hedging. Earlier I was talking about natural gas options exploding, which created quite a bit of havoc. We've been consistently hedging with long futures and things like that, but even then it gets a little bit hairy. I mean, the reality is I don't want to say all the time, but most of the time, selling calls against futures, selling calls against long options, that sort of thing is generally a better practice than simply buying options outright or buying futures outright without a hedge. But it can backfire. It's not perfect, just like any other strategy doesn't always work. Okay, someone's asking, what about buying straddles and nat gas? To be honest, I think that you missed the boat on that one. I could be wrong. Maybe volatility gets even crazier, but you're probably better off. I hesitate to say this because it's not for everybody, and most people should not do this. But the better trade is probably selling strangles or selling straddles. Although it should only be done if you have quite a bit of experience and you have a big account with lots of margin available to ride it out, because it would be very hairy and it's a dangerous game. For most people, the best position in nat gas is probably on the sidelines. If you wanted to purchase a straddle, to give you an idea, the December options expire in 50 days, and it would cost you probably $11,000 or $12,000 to buy a straddle. So that's a lot of money to risk on an eroding asset at a time in which options are higher priced than they've ever been in natural gas. So that is probably going to be a really tough way to make money. Not impossible, but not likely. In the S&P, I'll just put it this way. I'm watching 4,300. I mean, I think everybody is. As long as the S&P continues to close above 4,300, I think the bulls have a slight edge. But if we start closing below 4,300 in the futures, really, I think we could get a really good size correction. I mean, we're talking 4,000, maybe even 3,800. So, and to be honest, we're due for that. And this is the time of year that those sort of weird things can happen. So if ever there's a time of year that we can get a good size correction, it's probably in October. Probably be a great buying opportunity, but there's definitely some risk of a slide below 4,300. On the flip side, if 4,300 continues to hold, the uptrend line resistance will come in at about 4,500, 4,550. And if we break above that, then I think we've got a pretty nice year-end rally in store. So we'll see. We're right on. So in other words, we're right on the cusp of make or break. I wouldn't bet the farm either way at this particular price. All right, my time is up. I appreciate everybody coming out. If you need me, you can find me on social media or carleytrading.com. Send me an email. And yeah, we'll get you taken care of. One more quick question. Someone's asking, do you use levered call options? The reality is all options are levered. So like in the futures markets, the futures themselves are leveraged. So you're buying a leveraged asset that's written against a leveraged asset. So yes, it's very, very levered. The options that we spoke about today are definitely levered. So which is why we're buying and selling options together as a package to hopefully try to hedge that leverage and volatility. But again, things don't always go the way that you expect them to go. Even when the market goes the way you think it's going to go, it's not always a walk in the park. So yeah, interesting times. Thanks again for coming out. I'll stop my screen here.